Hi, everyone. Today we're going to talk about U.S. and international accounting standards. As Thunderbirds, you're all going to be very interested in knowing something about the international standards as well as just those that are used in the United States. Now, from previous reading, you know that this is a social science, not a natural science. And as a consequence of that, we know that this is material that was designed to meet the needs of users. And indeed, if we don't meet the needs of financial statement users, there's really no reason for us to be in this business. Now, from a historical perspective, the oldest written accounting records are also the oldest written records. We've got cuneiform tablets that go back to the dawn of written records that are accounting records. They're single entry accounting systems, which means they're just a listing of the resources that the business has. And in this case, they were all agricultural resources. Luca Paciolo, who, by the way, that name is often spelled with an I here, both ways. Luca is called the father of accounting because in 1494, Luca Paciolo wrote a monogram. And the monograph was a description of the double entry bookkeeping system. And hence he's called the developer, the father of accounting. Now, in truth, the double entry bookkeeping system actually dates back to about the 10th century in the Italian city-states. So Luca just was the first guy to write about it, but we know that sometimes that gives you the credit. Now, what happened is that as double entry bookkeeping began to spread from country to country and place to place, we found that the standards for measuring and reporting were different from place to place. And the reason for that's relatively straightforward. The needs of financial statement users reflect the characteristics in the economy. And if you're an economy that has experienced a great deal of hyperinflation, for example, like our neighbors to the south in Mexico, you'd expect that they would have an accounting system that would account for inflation. We do not in the United States. They do in Mexico. And that highlights really the reason that accounting rules and standards developed from different places are different from each other. And social norms differ as well. And sometimes that sense of difference in social norm impacts the results. Now, the consequence is that we wound up with a patchwork, and it still describes the world today in some measure, a patchwork of national accounting rules. Now, that worked just fine as long as you always gathered your capital in your home country, and as long as you always sold your goods or provided your services in your home country. But when we began sourcing capital outside our home countries and doing business throughout the globe, a problem developed. And the problem, of course, is that with all of these different accounting rules, it's relatively difficult for us to look at another country's accounting reports and believe we understand them. So we started to cope with this problem of multiple accounting rules all over the place. Now, financial reporting standards, we perhaps ought to define them. We will say that a financial reporting standard is just the rules that govern what is to be accounted for, when it is to be measured, how it's to be measured, and how it's to be reported. And our standards do all of that, as do almost all countries' accounting standards. And in the United States, we discovered that our standards were pretty slow and pretty late to develop. Before 1933, all we had was a loose collection of commonly used methods and measures, and we called them generally accepted accounting principles. So if you just think about that title, it shouldn't surprise you that this is nothing more than a group of methods that seem to be generally employed out there. And it was quite a hodgepodge. There was no single place you could go to discover what acceptable accounting was. No single book, no single set of rules. And that described our country and our country's accounting until the Great Depression. And in the Great Depression, we got the Securities Act of 1933, and from the accountant's perspective, even more importantly, the Securities Exchange Act of 1934. And the Securities Exchange Act of 1934 gave the Securities Exchange Commission the authority to authorize generally accepted accounting principles, to define those rules and standards that would define good accounting. And they required that annually audits be obtained for all financial reports for companies whose shares were traded in interstate commerce. And then the absence of the book, of the set of rules that we would all know were good accounting, became a real problem. Management didn't know how to prepare financial statements. Auditors didn't understand how to bless financial statements, and the Securities Exchange Commission was a bit unsure about how to receive and accept a set of financial reports. And so it became necessary for us to develop that set of standards that we'll call in the United States still generally accepted accounting principles. The Securities Exchange Commission clearly had the legal authority to develop this set of standards on its own. But the decision was made that they would rely on the private sector with their own influence and ultimately their own acceptance. And so the American Institute of Accountants, which was later to become the American Institute of Certified Public Accountants, and the SEC agreed to jointly develop these standards, and that the American Institute of Accountants would take the lead. And a committee was formed in the American Institute of Accountants called the Committee on Accounting Procedure. And they produced from 1938 to 1959 accounting research bulletins. And primarily what the ARBs did was codify, put in writing, a description of and an understanding of all of those generally accepted accounting principles. Some effort was made to reduce the number of alternative principles that could apply to any situation, but it was primarily a listing and a gathering together. In the late 1950s, it had become apparent that we needed something a little tighter, a little more prescriptive, and we needed more attention paid to this process rather than simply a committee of volunteering CPAs in the American Institute of Accountants. And so in 1959, the Accounting Principles Board was placed in service, replacing the Committee on Accounting Procedure. And from 1959 to 1973, they promulgated Accounting Principles Board opinions. Now, the Accounting Principles Board opinions were terribly important. Some of the most extraordinary work in the development of accounting standards was done by the Accounting Principles Board. Unfortunately, they were a very large group of people. There were 17 members. They were slow. And if you remember that a camel is a horse designed by a committee, you sort of understand the problems that they faced in their negotiations with each other, their discussions, and in the challenges associated with putting together those final opinions. They also, when they published their opinions, they published really well-designed, succinct 10, 15, 20-page documents. But they had made the decision early on that they would permit minority reports to be filed. So if you were a member of the Accounting Principles Board and you disagreed with the decision, you were permitted to write your own personal report, a minority report. And so often an Accounting Principles Board opinion came out. It was a statement of 15 or 20 pages of the way things were going to be, and then an awful lot of verbiage written by those that were dissenters. It was unfortunate. It confused. It made it difficult for us to decide really what we were supposed to do, and that became a real serious problem. Charlie Horngren was a university professor at Stanford who was a CPA and a member of the Accounting Principles Board. And at the end of its life, Charlie said that being a member of the Accounting Principles Board was like being a lone tree surrounded by 1,000 dogs. And Charlie had a way of putting things. So, in 1973, the shortcomings of the Accounting Principles Board were presumptively cured by moving over to a new organization, the Financial Accounting Standards Board. And the Financial Accounting Standards Board, beginning in '73 and still today, is the organization that creates financial accounting standards in the United States. Now, at the same time, the United States began to seriously consider, along with other developed countries, the problem of doing business in emerging economies that had no accounting standards of their own. And so these 17 member countries decided that they would pull together a set of standards that would be designed to be used in these emerging markets. They began their work in 1977. Slowly, though, the focus of their attention became not just developing a set of standards for emerging markets. They also became, as a central focus of their work, developing a single set of accounting standards to be used in the entire world. And that was their devotion, their attention. By 1988, the Securities Exchange Commission, aware of what they were attempting to do, published its approval and support for the work of the International Accounting Standards Board. And in 1997, the Securities Exchange Commission highlighted the great cost associated with trying to do these accounting reports for each country and having different standards everywhere. They estimated that we probably spent in the world about $10 billion a year trying to cope with differing accounting standards. The SEC was so strongly supportive of this that in 2008, they published a roadmap, a design, a calendar showing how we could get from one place to finally a fully converged set of U.S. and international standards that could be used throughout the world. Now, the basis for that roadmap was the Norwalk Agreement. The Norwalk Agreement was reached in 2002, and it created a process for the Financial Accounting Standards Board and the International Accounting Standards Board to work together to converge U.S. and international standards. The Norwalk Agreement gave these two bodies 10 years to put these processes in place and complete the convergence process. Unfortunately, although we got some early low-hanging fruit in the process, it began to lag. And finally, in 2014, the SEC published a white paper. And in that white paper, they rejected the International Accounting Standards Board as a sole standard setter, and they rejected International Financial Reporting Standards as the sole acceptable set of standards for the United States. There were a number of issues that the SEC pointed to. They have a lot of influence and control over the Financial Accounting Standards Board. They knew they would have a good deal less influence and certainly a good deal less control over the International Accounting Standards Board. The International Accounting Standards Board always pushed, always wanted countries to adopt their standards automatically, that if they wrote it, that was the way it would be done. And the SEC rejected that idea. They said that the SEC had a legal obligation to develop sets of standards that would work throughout the world, but that would also work and primarily be focused on the United States. And they didn't think that they could walk away from that legal obligation. They also noted that the standards that they had seen from the IFRS didn't constitute a complete set of accounting standards. It's understandable. The International Accounting Standards Board had only been in this business for a few years, and we in the United States have been developing standards for the better part of 150 years. So the convergence process was not successful. Although we can say that it failed, and certainly it did not yield a converged set of standards, we also have to recognize that it did provide us with some fairly significant benefits. We got a very nearly complete review of standards in general. And we learned a lot about our standards and about the way that other countries could think about doing these things. And so in the United States, we often adjusted our own standards somewhat. The distance between these two sets of standards clearly was reduced. And several areas were successfully converged. The area of leases, the area of marketable securities, and a variety of others. And it's no doubt that we can say that the International Accounting Standards Board and its work has been relatively successful. By 2010, 114 countries require or permit the use of IFRS, the International Financial Reporting Standards. And interestingly enough, we do in the United States in one limited circumstance. As long as the registrant, the provider of the financial reports, is a foreign corporation whose securities are traded in the United States, they are permitted to use IFRS in the United States, but only in that limited case. So we have a lot of benefits from the convergence process, but it may be a while before we're ready to go forward. Now that's enough about accounting standards. I hope you enjoyed it. I look forward to hearing from you.